Investing is a hot topic these days, and we've seen investing app downloads spike, like you can see right here. I love that the internet and fintech is making investing more accessible, and social media is spreading the word that investing is a very wise idea. Now, with that said, I see a lot of investing mistakes, especially with newer investors. So I wanted to give you some top mistakes to avoid so that you can build wealth like a pro and avoid getting gray hairs. I'll explain that one later. So the first investing mistake to avoid is investing in the wrong accounts for your tax situation and investing strategy. I see this one all the time. People have lately been going straight for Robinhood accounts, and I totally understand why, because Robinhood is very easy to use. But at the time of this video, they only offer what's called a taxable brokerage account. This means that you owe taxes on any dividends and capital gains that you take every year. Nothing is deferred. And they don't offer any tax deferred or tax advantage retirement accounts as of now. Here's a video that touches on these types of accounts if you're unfamiliar with them. I'll post it in the show notes below as well. You may be thinking, well, I don't care about that. I want access to the money now and not when I retire. Well, here's where the big investing mistake can be made. Depending on what you're investing in and what your investing strategy is, you might be doing yourself a huge disservice later by not taking advantage of retirement accounts first to put your money before going to a taxable brokerage. If you're trying to trade and make quick profits to use now, sure, you'll want access to that money via a taxable brokerage account, even though you can actually do this in some retirement accounts like personal IRAs or self-directed IRAs. But if you're investing for the long run, especially in higher returning stocks, the first place you want to try to go would be a Roth IRA if you qualify and you're in an attractive tax bracket today. Or if you have access to a Roth 401k at work, there are no income qualifications to be able to contribute to it, which is awesome. Roths are tax advantaged accounts. So why would you consider this? Well, the money that you're contributing has been taxed at today's rate, and the earnings grow tax-free. So investments that are expected to compound at higher rates of return do much better for you in this type of account. High rates of compounding growth that is tax-free is a major benefit for your future self. Plus, the money's not necessarily locked up. That's for another video. The other thing to think about before you dive for that taxable brokerage account is if you're looking to save money on taxes today by contributing to a tax-deferred account like a traditional IRA or 401k. Instead of paying Uncle Sam out of pocket and then investing in a taxable brokerage, what about paying Uncle Sam less in a given year and taking the money that you save and investing it in a tax-deferred account? Now, don't get me wrong, taxable brokerage accounts are a very great place to invest. I have one. Many people have them. They definitely are useful if you plan to hold stocks for a long time to take advantage of preferable capital gains tax rates. The key word though here is holding those stocks. When you start to have a lot of turnover in a taxable portfolio, aka moving in and out of assets, this can really reduce the effectiveness of a taxable brokerage for your longer term wealth. However, are they the best place to go first? Usually not from a financial planning perspective. Keep in mind that capital gains rates can change in the future depending on who's in office. Ultimately, the goal is to be tax diversified across all of these types of accounts. So keep that in mind. Because honestly, nobody knows the future of tax rates. Nobody knows exactly where they'll be. You have to consider your tax situation, your investing strategy, and your overall financial goals to get you to the right account starting off. The mistake to avoid is not considering all of those factors. The second investing mistake to avoid is not being clear on your investing strategy. There are so many ways that you can make money in the markets. You can be a shorter term position trader, a long-term passive investor. This is going to be most 401k investors. You can be a long-term active investor, aka a stock picker, or a mix of any of these. Then drilling down from there, you can invest in the particular types of assets or styles of those kinds of assets. What I find is that beginners are all over the place. They want to make quick profits, but they also want to invest for the long run. Then they let short-term movements affect how they manage their long-term strategy. It's just all over the place. So here's a tip. Think about how much time you want to put into your portfolio. Passive investing is a set it and forget it strategy, investing in funds. Active investing is stock picking. So consider what you want to be doing to grow your wealth. If you want to set it and forget it strategy, stick to that. Don't let any media noise distract you and focus on your long-term goals of compounding your money. If you want to invest in more than one strategy, think of your portfolio in cohorts. Figure out exactly what percentage of your capital you want to dedicate to each investment strategy. And don't get your wires crossed. Different strategies are supposed to be managed differently. So you gotta understand that part. The third investing mistake to avoid is getting over emotional or dogmatic around specific investments. If momentum stocks in 2020 into 2021 taught us anything, it's that market environments can get overzealous. And as the saying goes, the market can remain irrational longer than you can remain solvent. But one thing that I've learned in this business is that just when you're feeling super confident in your investing, the market tends to come along and give you a hot serving of humble pie. Let's dive into some data. I pulled some of the best performing stocks from when all the hype started back in March of 2020 through today in 2021. It was an extremely emotional time in the markets, rivaling the dot-com bubble. I noticed anecdotally and in the data that many of the top performers during this period had some steep sell-offs after the hype wore off a little bit. This is the thing. People were truly feeling like their stocks couldn't lose. Everyone was getting hilariously wealthy in 2020 investing in stocks and floating on cloud nine. I was even part of this cohort. I couldn't even believe some of the things that I was seeing in my own portfolio. I remember looking at my thriving profit and loss report at one point and saying to myself, oh boy, it was almost too hot, too euphoric. Yes, I was looking at my profits thinking, this can't be good. I have been talking about how investors should prepare for this momentum in the markets to cool off. So let's look at some stock darlings that people were, let's just say, having the feels about during this time period. These were some top performers from 2020 into 2021. Blink Charging, Plug Power, the Wall Street Bets darlings GameStop and AMC, and I threw in Workhorse. There are many others, but I wanted to keep the charts clean. The returns on some of these names, as quickly as they had them, were astronomical. It was breathtaking to actually watch some of these stocks run. And I love a good short squeeze, but the issue was how emotional and dogmatic I noticed everyone getting over different types of investments. Some popular verbiage used during this time period and still used today because it's funny, to the moon, which meant it's going up really high from here. Diamond hands was another one, which means you plan to never sell no matter what happens. Honestly, this is all funny. We've all had many laughs over a lot of this stuff, but the thing is until your to the moon diamond hands leave you as a bag holder, that's where the trouble comes in. And a bag holder is someone holding a stock that has come down a lot from its highs and isn't expected to go back to where they bought it. And this leads to exhibit 1, regrets. Check out this survey from Magnify Money. It's showing that 66% of people made investing decisions based on emotion that they later regretted. And I can confirm this from working with hundreds of traders and investors on their mental game. This is absolutely an issue in investing. So back to everybody investing like it's 1999. See what I did there? Dot-com bubble. To illustrate why you need to keep emotions in check, let's check out some of the pullbacks from the highs that these stock darlings had after the hype had cooled down a little bit this year. Some of these names are still in deep drawdowns, anywhere from being down 50% to almost 90% from their highs. These are very steep drawdowns. The emotions are in high, my friends, and this led to major volatility, which, to be honest, most people have trouble stomaching that type of volatility. And then that's where you insert regrets here. Now, before you come at me for talking so negative about these popular names, could these stocks continue to truck higher from here? Absolutely. Anything can happen, especially in today's markets. But the data is in our faces and showing us that stocks don't always go up, and you need a plan for tackling any emotions that come with that. So what's the moral of the story here? Well, your investing should be 3 things. 1, it should be calculated. Be sure you have a basis behind your investment strategy and you're not just following crowds. do research, and have a plan. You really don't want to be just winging it in investing, because when the bad time comes, that's when the emotions take over and bad investing decisions are made. 2, your investing should be egoless. There's no room for ego here, period. The market loves to prove you wrong. It's proven me wrong. Even Warren Buffett has had investments go wrong. 3, your investing should be risk managed. Make sure that you're taking on the appropriate amount of risk for your risk tolerance and your risk capacity. Not managing risk is one of the biggest causes of emotions in investing. Consider the volatility of the assets that you're investing in and your overall financial situation. If you have kids and no emergency fund and hate losing money, you probably shouldn't be 100% invested in assets like Bitcoin or meme stocks. These are very volatile assets. So I'll say that again, because it's just that important. Not managing risk is one of the biggest causes of emotions in investing. All right, we covered a lot. Here's a recap on the top 3 investing mistakes to avoid. 1, investing in the wrong accounts for your tax situation and investing strategy. 2, not being clear on your investing strategy. We don't want you all over the place, which can lead to mistakes with your money. 3, getting overly emotional or dogmatic around a specific investment. Not everything is actually going to the moon. All right, if you like this video and you found it helpful in any way, please hit the like, subscribe, and I'll see you in the next video.